So Biden inflation is back at it again, right? That's what Donald Trump said when the numbers came out hotter than expected, right? We got the CPI numbers that came out on Wednesday way above the expectation, that caused the stock market and the bond market to both sell off when we got the numbers, right? So how did it come out? What were the numbers? Let's discuss it here. Starting off with the month over month number coming at core month over month number coming at 0.4 versus 0.3 expected. The CPI headline month over month number that is often televised in the media, 0.5%. Versus the 0.3%, and also the other headline year over year number. Sorry, this is the one that's televised in the media, coming at 3.3% versus the 2.9% here, which is the expected, and the core year over year 3.3 higher than the expected of 3.1. So all the numbers coming in hotter than expected, but the biggest thing here when you look at the headline month over month, 0.5 month over month change versus the expected 0.3. Okay, that's hot. That's pretty high. All right, so let's look at the BLS website here, which talks a little bit in depth about the inflation. So just cover here the second and the third paragraph. It says that the index for shelter rose 0.4% in January, accounting for nearly 30% of monthly all items increase. Okay, so shelter component rising. The energy index rose 1.1% over the month. The gasoline index increased 1.8%. The index for food also increased in January, rising 0.4%. As the index for food at home. Here's an interesting one. Food at home, grocery prices and whatnot rose 0.5%. Okay, when we look at the past 7 months, when we look at food at home, it's been the highest over the past 7 months. This month in this report, okay, 0.5%. We haven't seen that. The highest we saw was 0.4% in November 2024, but we actually moved up higher than that in the past 7 months, which is this report, which comes out at 0.5, right? So we got the 0.5%. So food at home is more expensive, and the index for food away from home also increased at 0.2%. The index for all items less food and energy rose 0.4%. Indexes that increased over the month include motor vehicle insurance, recreation, used cars and trucks, medical care, communication, airline fares. The index for apparel, personal care, household furnishing, and operations were among the few indexes that decreased, right? No one's going out and purchasing those couches and updating their home inside. Because why, right? Because food is expensive, shelter is expensive, your essential needs continue to be more expensive. So problem, right? So what can we get from this report? What can we digest from this? Well, first of all, looking at this report, that it's probably not new news for you. You probably go to the grocery store, you probably see it out there in the real estate market and whatnot. Shelter and food, your two essentials, have been and continue to be high and continue to be elevated and continue to pinch consumers. Therefore, that's why when you saw the start of earnings, and a lot of these tech earnings out there basically report future guidance being weaker than expected, is because the consumer is getting weaker, and it continues to trend that way. And we have yet to see the true blow on the consumer, the true effects that will affect the consumer, especially if we will start to see, and if we start to see the unemployment rate move up higher or the job market get worse off, you'll definitely see the consumer feel the pain even further, right? And that should maybe alleviate some of this CPI and inflation metrics. But until then, right, you got higher inflation, earnings, a lot of these earnings coming out talking about weaker guidance, right? And it has been for quite some time, where you see food and shelter continuing to be up there, and people feeling the pinch regardless of those rate cuts that we're getting from the Fed, regardless of that help that FOMC is trying to do. It's not working out so far, right? So in terms of real life, it looks like, you know, inflation is here to stay around and stick around for some time. Now the caveat is, what if the trade war issues get worse off? What if, you know, tariffs come in? Right now, right, Trump, you know, the markets are a little optimistic because Trump is not being as bad as they expected. It's always about the expectation versus reality, right? So the expectation was he was going to be really bad, but the reality is not that bad. He's pushing back on those tariffs for now, right? But if he comes in hard and spooks the markets, then things could change in the equity markets, and definitely things can change when it comes to these inflation reports. Things could become more expensive if you got straight out trade war happening and it's getting worse than expected, right? So that's one part of it. The other part of it is when you look at the reaction from the stock market after this report, right? The report, when it came out, we saw a sell-off, but then it got reversed on that day. So the equity markets shrugged it off. Bond markets somewhat a bit. We're seeing a bit today after a couple of days from the CPI. That could be attributed to multiple things, but the biggest key here is the equity market shrugged it off, the CPI report, the hot report. And what does that signify? What does that tell you? Well, that tells you is that, okay, if inflation is going to be sticking around, it may be because of the previous administration that may have caused something. So we have yet to see more. And we have Trump basically blaming Biden was the reason, and he's going to fix the inflation issue. So that could be another reason for things to reverse course and the equity markets to shrug it off. And the third one is the tariffs are not being as bad as expected. So therefore, you could foresee in the future better inflation reports, you know, better in terms of prices. So again, a report to be shrugged off again, right? So those could be some of the reasons. Now the fourth one I'll mention is also, what's an inflation hedge, right? Equities, stocks, NASDAQ, Bitcoin, gold, they tend to be an inflation hedge. So this is important when it comes to, when you're trying to hedge against inflation, is to be long those assets, right? So that's another reason for it to reverse. Now, even though you may feel that inflation's higher and hotter and it doesn't look like it's going to get worse off, the equity markets may not feel that and may be projecting something else completely differently, right? And that's what we got. And we're seeing here that the equities are moving higher. We're seeing here also the pullback from the softness from the Trump tariffs, causing the equity markets, causing NASDAQ and S&P 500 not so far away from all-time highs. So where do we go from here? Well, equity markets continue to buy the dip. We continue to move up higher until new information comes in, which is regarding the tariff war and with these inflation reports and the job market. So if those things are not getting worse off and things are okay, then to the moon, to all-time highs until something breaks, right? So anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.